Welcome, traders. James Gaverty here, and you are dialed into today's market call. Look, if you're hunting for basic market theory, you're honestly in the wrong place. But if you want a precise, over-the-shoulder blueprint on exactly how to tackle the Dow E-mini right now, then I suggest you grab a notepad. We're going to break down exactly what the smart money is doing behind the scenes and how we're setting up our battle plan for the days ahead in this explainer.
So let's dive straight into this. For all you active day traders and swing traders out there, our goal today is explicit and totally uncompromising. We are looking to fade the rally. Now, we aren't doing this based on some gut feeling or a random squiggly line on a chart. We're doing this using institutional-grade COT data analysis from Signal929.com. Understanding how to really read the commitment of traders' data is what separates the professionals from the retail crowd that constantly gets chopped up. We are here to track the footprints of the big players.
Let's get right into our core thesis. Section 1, the 68% bearish signal.
As a trader, your ultimate job is to find asymmetry in the market. You need to know when the odds are heavily stacked in one direction, and right now, the data is absolutely screaming at us. We're tracking a very specific, heavily weighted signal that tells us exactly how the commercial hedgers, the true smart money, are positioned in the Dow E-mini. 68%. I really want you to let that number sink in for a second. This 68% bearish signal is the absolute anchor of today's entire analysis. When the underlying data hits a threshold like this, it's not just a polite suggestion. It's a glaring warning sign that the prevailing market momentum is very likely a trap.
Let's look at the specific positioning data driving that 68% verdict. If you look closely at the commercial net positioning, you'll see they are net short by 2,999 contracts. But listen, it's not just the total number that matters here, it's the trajectory. They are actively adding to those shorts, dropping another 981 contracts just week over week. And here's the real kicker. They are doing all of this while the price is sitting way up at 85% of its 52-week range. The smart money is aggressively selling into this high pricing, establishing a crystal clear short rally signal.
That brings us right to Section 2, smart money versus the public.
Let's break down this classic tug-of-war. What we are really looking at here is a battle of perception. The retail bull case is built entirely on surface-level momentum. The public sees the Dow has rallied 4.7% over 13 weeks, pushing up to 52,375. Because the trend looks technically intact, retail traders just assume the breakout is real, and frankly, they're terrified of missing out on new highs. But we have to juxtapose that against the institutional bear case. The commercials are currently at the absolute minimum net long, which means maximum net short over the past 13 weeks. When you have rising open interest while commercials are outright refusing to add longs, that tells us the speculators are the ones doing the buying, not the smart money. When price is this high and commercials are this quietly and strategically short, the risk-reward strongly favors the downside.
The crucial tipping point is found right here in the Godfather Index. If you follow the Williams methodology, you already know how incredibly powerful this is. The 13-week index is sitting at a dead zero, the 26-week is at 9, and the 3-year 156-week index is at 29. What does this mean for us? It means across all these measured windows, commercials are at or near their most extreme short positioning. This methodology flags an index of 0 on the 13-week as the single strongest near-term bearish contrarian anchor available to us. It is a classic 3-year extreme. The smart money has literally loaded the boat with shorts.
Let's pull back for a second and see how this builds into the broader structural picture. Looking at the cycle spectrum and market crosswinds, the cyclical downward pressure building up is unmistakable. The underlying phases are aligning perfectly with that commercial short positioning we were just talking about. You've got major headwinds converging, indicating that the market condition, regardless of all the intraday noise, is setting up for a significant mean reversion.
And as we all know, timing is everything in this business. Historically, mid-July marks peak summer optimism in equity index futures. All the Q2 earnings expectations get fully priced in, and it usually gives way to a massive pre-August positioning reduction by institutional players. August through September is statistically the weakest seasonal window for U.S. equity index futures. Add to that the lower late summer volume, which naturally amplifies downside moves. The seasonal clock is ticking right now, and it is firmly ticking in favor of the bears.
All right, we have the data. We know the setup. Section 3, the short rally setup. Let's map out the actionable trade plan.
I hope you have your pens ready, because here is the exact blueprint.
We are looking to favor initiating short exposure on any interweek bounce into our entry zone between 52,700 and 53,000. We want to fade that bounce toward the prior June-July range top. Once we are filled, our first target, T1, is at 51,300. That's the June 8th close support and roughly a 50% retracement of the whole April to June rally. Our secondary target, T2, is further down at 49,800, right at the April swing lows cluster. And listen to me very carefully on this next part. Your stop loss is an absolute hard stop at 53,700, just above the 53,656 annual high. Do not give it a single tick more. That is our hard line in the sand.
Section 4. CFTC Disclosures and Reality Check. Before we wrap up, we need to talk seriously about protecting your capital.
Having a great setup is honestly only 10% of the game. Protecting your account is the other 90. So let me be absolutely clear here. The content of this explainer and all related market analysis are provided strictly for educational and informational purposes only. I am not a registered financial advisor, and this is not personalized financial, investment, or trading advice. You are solely responsible for your own investment decisions. There is a substantial risk of loss in trading futures. It is highly risky, and it's simply not suitable for all investors. You can lose all of your initial investment, and in some cases, you might even lose more than your initial investment. You must only ever use true risk capital, money that can be lost in its entirety without jeopardizing your financial security or lifestyle. And always remember, past performance of any methodology or analysis is not necessarily indicative of future results.
Finally, in accordance with CFTC Rule 4.41, hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not actually been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. But I want to leave you with this question to ask yourself. When the smartest commercial money in the world is loading the boat with shorts at a 3-year extreme, can your portfolio truly afford to be blindly chasing the retail rally? Trade smart, protect your downside, and I will see you on the next market call.